over the years, things have become more mechanized, and payroll tax returns have become more mechanized. So we didn't have to go out quarterly to do those kind of compliance things. It could all be done by internet, and so we kind of lost a little bit of the quarterly contact that we had with all our business owners. So I always wanted to do accounting, and I see that over the years, accounting for especially small and medium-sized accounting firms, we're about 20 strong right now, so we're not that small, but nevertheless, the accounting departments are usually subsidiary to the tax departments. We love taxes. We love tax planning. We love tax compliance, and I think we're exceptionally good at it. But I also wanted to maintain our accounting skills, so we hired actually an accounting manager from one of the big four. We hired another staff person to work with that person, and plus we have existing people who go both ways, tax and audit. And so we have really started to ramp up our audits, because that's what we went to school for. And I like doing accounting. I remember in my first job, we'd go out and you'd have to learn how to make journal entries. You classified that as office expense. It's really repairs. Or you wrote off all of that insurance, even though the policy says that insurance doesn't expire until a year from now. So we should prorate that insurance expense every month instead of just writing it off in the time that on the date that you paid for it. And so we would march through the balance sheet, and it was kind of fun, especially for a young accountant. You looked at the cash account and said, well, let me see your bank reconciliation. Let me see if that ties out to what your general ledger and cash says. And normally the bank statement won't agree to the cash in the ledger because there's outstanding checks or there's deposits in transit. There's always a timing difference. You have to account for that. Oh, let me see your receivable, your AR receivable aging list. Let me see if that ties out to the accounts receivable that you say your customers owe you. Oh, look at that. I see that the accounts receivable, you have a lot of old stale receivables from about a year or so ago. Do you think you'll ever collect them? Do you think we should write off some bad debts? These, I see that you bought some equipment. You say you're depreciating over 15 years, but that equipment's only going to last 7 years. If it's a computer, 3 or 4, and you're depreciating it over 10 years, means the depreciation provision is not sufficient to capture the replacement cost that you're eventually going to have. Did you make all your accruals? Do you have all your accounts payable, captured at the end of the year? Because even though you didn't pay for an expense at the end of the year, it's still an expense, right? You incurred it, and we don't want to deceive the investor or the reader of the financial statement that you didn't incur expense just because you didn't pay for it. So do you have all your payables? And so we marched down the financial statements. When we got to notes, we looked to make sure we get the documentation for the notes. And oh, you usually pay in arrears. Don't you owe at least a month worth of interest? So we'd accrue the interest, that kind of stuff. And then you put together all of this, and you end up with hopefully a fairly accurate financial statement. With a balance sheet showing the owner, this is what you own, it's your assets, this is what you owe, this is your liabilities, this is your equity, the difference between the two. And here's what you made. This is your revenues, this is your cost of goods sold, these are your operating expenses, this is your net profit. If you have net profit, your stockholders' equity should have gone up from the last period. So we would check that stuff.